Today we're going to talk about something that might sound, well, a little dull. It's called the boring portfolio. But stick with me, because this could be one of the most exciting things you ever do for your financial future.
This video costs you nothing but less than 5 to 6 minutes, but it will make you one of the smartest people in the room. Today, I'm breaking down the boring portfolio. If this shifts your perspective, please like and subscribe. That's exactly why BRAINELM Lab's channel exists.
I get it. The word boring doesn't exactly scream, get rich, does it? But I want you to consider this for a second. What if boring is actually the secret weapon, the key to building real, lasting wealth over time? Let's unpack that. So, to really get why boring is so powerful, we first have to talk about a huge problem out there, what I call the investing complexity trap. There's this pervasive idea that to be a good investor, things have to be complicated. A dizzying, confusing game. And you can really see the two paths here, can't you? On one side, you've got the complex way. It's full of stress. It's a guessing game. And frankly, it often benefits the financial industry way more than it benefits you. That complexity is where they get you, with the high fees, and those fees will absolutely eat away at your money over time. But the simple way? That's about peace of mind. So, let's just pause and ask a really important question here. What if all that stuff, the fancy charts, the so-called expert predictions, the 24/7 news cycle, what if it's all just noise? What if it's designed to distract you from a much simpler, clearer path? And that's really the soul of the boring portfolio right there. The goal isn't to be some genius who outsmarts the entire market, no way. It's about tuning out the noise, getting rid of the stress and the high costs, and just owning a piece of the whole thing. Okay, so what is this boring portfolio actually made of? Well, this is the entire blueprint. And you're going to love this. It's built on just 3 super simple ingredients. Yep, that's it. That's the whole shebang. A U.S. stock fund, an international stock fund, and a bond fund. So let's break down exactly what each of these 3 pillars does. All right, pillar number 1, U.S. growth. I want you to think of this as the main engine of your portfolio. This is where the real long-term power comes from. So what is this thing, really? Well, a total U.S. stock market fund is basically like buying a tiny slice of every major public company in America. Instead of trying to pick the next big winner, you just own a little piece of all of them. Simple as that. Let's make this super practical. Imagine you have $1,000 to invest. A really solid starting point is to put half of it, so 50%, $500, right into this fund. And just like that, you're a part owner in thousands of U.S. companies. You're not betting on one company, you're betting on the entire American economy. Now for our second pillar, global growth. You've heard that old saying, right? Don't put all your eggs in one basket. Well, that's exactly what this is all about. It's about diversifying your investment beyond just the United States. This fund works pretty much the same way as the U.S. one, but it invests in big companies from all over the world, Europe, Asia, you name it. With this one investment, you get to own a piece of successful businesses in all these other growing markets. So let's go back to our $1,000 example. You might put another 30%, that's $300, into an international fund. See what we just did? Now you're not just relying on the U.S. market. You've spread your risk across the entire globe. If the economy in one part of the world is having a rough year, another part might be booming. It helps to smooth out the ride. And that brings us to our third and final pillar, the stabilizer. Look, stocks are fantastic for growth, but let's be honest, they can be a bit of a roller coaster. This part of the portfolio is all about bringing some calm to that ride. So what in the world is a bond? It's pretty simple. If buying a stock makes you an owner of a company, buying a bond makes you a lender. You're basically loaning your money to governments or big corporations, and in return, they pay you interest. The key thing to remember is that bonds are generally much more stable than stocks. They're your anchor. And now we complete our $1,000 portfolio. That last 20%, the final $200, goes into a bond fund. This is your shock absorber. When the stock market inevitably hits a rough patch and things get choppy, your bonds are there to help cushion the fall. So when you just lay it all out like this, which path really makes more sense? The complex way with all its stress and hidden fees, or the simple way, where you own the market, keep your costs super low, and actually get some peace of mind? I think the choice becomes pretty clear. This analogy is just perfect. Think about your portfolio like a tree. It doesn't need all these complicated tricks and fancy fertilizers to grow. It just needs the basics: This three-fund approach gives you those basics. It's the water, the sun, and the time that lets your wealth grow, steadily and strong.
All right, so what's the big takeaway here? How can you actually put any of this into practice? Let's make it super simple. Here's your one actionable takeaway. Start exploring. That's it. Look into opening an account with a reputable, low-cost brokerage firm. You'll find that they make it incredibly easy to set up this exact kind of three-fund portfolio. You might be surprised at how simple it is to get your own boring but incredibly powerful portfolio started.
If this helped you think clearly about the boring portfolio creation process using just 3 funds, please like and subscribe. The next video covers what most people still don't see.